All right, let's get straight to it. We're here to talk about the Australian dollar, which has just staged an absolutely powerful breakout. Now, what's the driver? Well, it's a sudden, hawkish pivot from the Reserve Bank of Australia that has basically redrawn the map for G10 currencies. We're going to break down exactly what this means for you and what to look out for next. So here's how we're going to tackle this. First, we'll look at the catalyst. What exactly lit this fire? Then we'll get into the core thesis here, which is all about policy divergence. After that, we'll jump into the charts to see the price action, dig into the economic drivers behind it all, and wrap up with a tactical playbook for that crucial RBA decision coming up. You know, the entire market shift really started with this one single sentence. These remarks from the RBA's Deputy Governor Andrew Hauser were, well, they were a complete U-turn from their previously cautious, almost dovish stance. The market was basically betting on them to wait and see, so this signal to remain vigilant was a massive warning shot on inflation, and it forced an immediate and, I mean, aggressive repricing. And this is the result of that repricing. In less than 48 hours, money markets went from pricing in basically zero chance of a March rate hike to a staggering 75% probability. Now, this isn't just a small adjustment. It's a fundamental rewrite of the RBA's entire policy direction. This immediately blew out Australian bond yield spreads, and that's what's pulling in the big capital inflows fueling this whole rally. Hauser's comments really triggered an avalanche. I mean, within a day, you had 7 major banks just scrambling to update their official forecasts. It was incredible. A consensus for a March 17th rate hike formed in just a matter of hours. And for traders, seeing all these big institutions singing the same tune, that was a clear green light to push the Aussie higher. So this whole move is built on one core thesis: policy divergence. The real key to this trade is understanding the widening gap between what the RBA is doing and what the U.S. Federal Reserve is doing. And here's that divergence in black and white. On one side, you've got the RBA, now backed into a hawkish corner by some really stubborn inflation at home, and on the other side, the Fed, where softening economic data has the market pricing in just one single rate cut later this year. This growing gap in policy, well, that's the engine driving this entire trade. And this chart right here shows you the direct result. That interest rate differential, the yield gap between Aussie and U.S. government bonds, is getting wider and wider. So if you're a large institutional fund looking for better returns, this makes Australian assets, and by extension the Aussie dollar, way more attractive. This is the flow of money that's powering the breakout. Okay, so let's see how this thesis is actually playing out in the price action. We'll take a look at the key technical levels this divergence has created in the market, starting with the big one, AUD/USD. For AUD/USD, the bulls have a very clear target in their sights, that 0.7200 level. And look, this isn't just a nice round number. It's a major technical resistance zone. If we see a sustained break above this, it could really open the door for a much bigger move. A lot of analysts are already looking at 0.7300 as the next logical stop. Now, on the flip side, this recent breakout has created some new and really crucial support zones. The levels around 0.7100 and 0.7050, they used to be the ceiling. Now they're the new floor. Traders are probably going to defend these levels aggressively, looking to buy on any dips. These are the new lines in the sand for this bullish trend. And the technicals, well, they're backing up the strength of this move, with the price now trading comfortably above both its 50-day and 200-day moving averages. It tells us that both the short-term and the long-term momentum are aligned. This is some strong validation for the bullish case. The story gets even more wild when we look at the Aussie versus the Japanese yen. The AUD/JPY cross has just exploded to a 35-year high. I mean, think about that. This is a direct result of that extreme yield difference between a hiking RBA and a super dovish Bank of Japan. Even the yen's role as a safe haven is getting totally steamrolled by the hunt for yield. This is a classic carry trade. You borrow in a low-yield currency like the yen to invest in a high-yield one like the Aussie. Right now, that flow is a torrent. So what is forcing the RBA's hand like this? Well, it really comes down to 2 key drivers we need to unpack: external energy shocks and sticky domestic inflation. These are the twin pressures that cause this whole policy U-turn. You see, the RBA is basically fighting a war on 2 fronts here. From the outside, you've got rising energy costs, a global shock hitting Australia's trade balance and what consumers pay. And then at home, you have persistent demand and a tight labor market that are keeping inflation stubbornly high. And we really can't overstate the size of this external shock. Oil prices have surged over 15% this month alone, thanks to geopolitical tensions flaring up in the Middle East. That flows directly to petrol prices in Australia, putting huge pressure on inflation and forcing the RBA to act decisively to make sure inflation expectations don't get out of control. All right, now for the most critical part of this briefing, the playbook. How do we strategically position ourselves and manage risk around this high-stakes RBA decision on March 17th? There are three catalysts on the immediate radar. First, keep an eye on Australia's consumer inflation expectations. If that number comes in hot, it'll pretty much lock in a hike. Second, U.S. jobless claims. Any sign of weakness there will just accelerate this whole policy divergence story. And finally, of course, the main event, the RBA decision itself. So here's a simple step-by-step guide. 1. Acknowledge the high volatility. Expect sharp moves. 2. Define your downside. What's your worst-case scenario? 3. The base case is to position for a hawkish hike. And 4, and this is the most important one, prepare your hedges. The real risk here isn't that the hike is already priced in, it's the chance of a dovish surprise. Let's focus on that downside risk for a second. The single biggest threat to this entire trade is the RBA unexpectedly hitting pause. A neutral decision would unwind this rally fast. So to protect your capital, you need defensive measures. This could mean using options to cap your losses or just having hard, predefined stop losses to get you out if the story breaks. And here's how this could play out in two very different scenarios. A hawkish hike, which is our base case, would likely send AUD/USD pushing towards 0.7200, AUD/JPY to new highs, and bond yields higher. But a neutral pause, our key risk, would likely trigger a sharp sell-off in AUD/USD back towards 0.7050 and a reversal in those bond yields. Visualizing these outcomes is absolutely key to being prepared. Now, if the RBA does deliver and this policy divergence narrative holds up, the upside could be pretty significant. Several of the big banks that just revised their short-term forecasts are also lifting their year-end targets, with some now seeing AUD/USD trading in a 0.7400 to 0.7500 range by the end of the year. But, and this is a big but, we have to consider the counter-argument. As this strategist points out, the market might be getting a little ahead of itself. What if the RBA's goal isn't a long, sustained tightening cycle, but just a single, one-and-done hike to get inflation expectations under control? If oil prices were to stabilize, that urgency for more hikes would just evaporate, and the market's long-term bullish bet would be completely offside. And that leaves us with the central strategic question that's going to define everything for the Australian dollar from here. Is this hawkish pivot just a temporary fix for a specific inflation shock, or does it signal the start of a new, long tightening cycle? The answer to that question will determine whether this breakout is just a short-term rally or the beginning of a major long-term trend.